is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded, our 101st. We have crossed the Rubicon into the hundreds, and we're starting off with a really terrific episode with a couple of great guests. And it's happening against a backdrop of a crypto asset market that I think a lot of people are starting to pay attention to, again, outside of crypto. And there's a couple of reasons for that. We saw BlackRock filed for a spot Bitcoin ETF in the US, and that has helped Bitcoin dominance exceed 50%. And then obviously on the back of the SEC's moves against Coinbase and Binance, we've seen a few different assets get singled out. Taken together, basically a Bitcoin and Ethereum now represents 70% of the market value. And it would appear that that position is going to remain so for a while. But if you look past the headlines of what's going on, there's actually a whole other story that's happening, which is that in the same month that Bitcoin and Ethereum have seen their dominance hit levels not seen in a couple of years, we've also seen DEX volumes across Ethereum and a range of other platforms hit their highest level ever at 22% of all total volumes. And beneath the surface of what you read in the headlines, there are communities of builders across various different platforms that are doing all sorts of really interesting things in DeFi and beyond in Web3. And we've got two perfect guests to talk about that, not the narrative you read in the newspaper, but the real story of what's happening with the builders in Web3. So I'm very pleased to welcome back to the show, Jack Zampolin, the CEO of Strangelove Ventures. Jack, nice to see you.
Well, we're just Strangelove now.
Pardon me?
Love. We're just Strangelove now.
Okay. Since you're the boss, does that make you Dr. Strangelove?
Yes.
Okay. So Dr.
I don't have a doctorate though. There's no doctorate.
Okay.
I just play one on TV.
Well, you can be like Dr. John, like the piano player. It's like an honorific. And then Jelena Djuric, who is the co-founder and CEO of Noble. I don't think we ever had you on the show, Jelena, but we've chatted many times before about what you've been doing both in the Cosmos community and now with your own thing. And you two happen to be collaborators as well in Noble. So we're going to talk a little bit about that as well. So first off, welcome to DeFi Decoded.
Thanks, Alex. Thanks, Andrew. We're excited to be here. So this is the 101st episode. Is this like a century kind of celebration then? Is there's going to be like balloons? Is there like, this is important, right? 100
It is important. Yeah.
That's
well,
very impressive.
It's the first day of the rest of our lives. Andrew and I record episodes of DeFi Decoded, whether our fans demand it or not. And as I said in my post commemorating the 100th anniversary, I think most of the views in the early days were our parents and Andrew's many siblings, who I actually have proof would like sit at the cottage and watch episodes of DeFi Decoded. And beyond that, I wasn't so sure. But now we do have a great listener base and some terrific people who give us lots of useful feedback on the show. So, and one of the things they always comment on is the high quality of our guests. So you guys don't disappoint today.
No pressure. Thank you.
All right. So Jelena, why don't you kick things off? Noble is a new venture and it's doing something really interesting. I don't want to, in any way take away from your description, but I will say on the show, we have talked a ton about stablecoin growth and how that's become this, really important new primitive in crypto, but in DeFi specifically, and how the growth of USDC has helped to fuel the growth of like lots of other areas. And how, right now, at least, I think USDC, most volumes happen on the Ethereum blockchain. But Andrew and I have talked a lot about other chains and the need for, different designs for different kinds of apps and even the app chain thesis with Cosmos. And that's got something to do with what you're doing. So why don't you tell us about that?
Yeah, absolutely. So, some projects, I think, especially in the crypto space and the Web3 space, which is ultimately a very nascent industry, they kind of come to the scene. They are a hammer in search of a nail, right? They kind of sometimes make up problems, or maybe they're even just copying and pasting like solutions that have already sort of found product market fit. Noble is very different. When we came together to come up or solve this big problem, which I'll describe in a moment. But, when we came together, it was something that actually a lot of other people were trying to solve for, right? So I guess I'll backtrack kind of a couple years. So Jack and I have been, colleagues, business partners, friends, peers for a number of years in the Cosmos ecosystem. The Cosmos ecosystem in general is this vast sort of community of independent entities that all sort of collaborate with one another, but ultimately are independent of one another. So Jack, a couple of years ago, well, he was obviously still at Strangelove, leading the team there. I myself was at Informal Systems. And we had this big event happen in Cosmos, which was the collapse of Terra. So Terra, which obviously was this incredibly successful project in many respects, unfortunately did face its demise. We had UST, which was the stablecoin, obviously, that was very well adopted, specifically in the Cosmos ecosystem, go to zero. And so myself, Jack, Zaki, Mannion, a couple others, got together and said, okay, well, this is horrible. We had this great success. We were in this bull market. We had this very well adopted stablecoin, UST, which in many ways was ahead of its time. And we had to come together and pretty much figure out how we kind of replace that, right? Like how we bring in another stablecoin, more reliable liquidity, more institutional demand to Cosmos that would sort of fill that vacuum. And so, as I mentioned, I was working kind of independently at a separate company. Jack obviously was leading the team at Strangelove. And we all kind of came together and said, okay, well, how do we do this? How do we let Proposition Circle specifically to come into the Cosmos ecosystem and figure out a way to issue their asset? Mm-hmm. You mentioned, Alex, obviously USDC is issued in other blockchain environments, obviously on Ethereum, Solana, Avalanche, most recently Arbitrum. Cosmos has always been an interest of theirs and a kind of a, something that they were exploring, but they never really understood how to sort of play or kind of issue within the Cosmos ecosystem. And so really we came together and came up with the sort of design and initial architecture for Noble, which we can obviously get into more details on. But really it was a problem that was like very evident that we had, right? Like no stablecoin liquidity in Cosmos, this like one asset that was so well adopted, went poof. How do we manage that? How do we, use that as an opportunity to actually help our ecosystem grow? And so that's what we obviously set out to do about a year ago. And yeah, we're very close to launching native USDC and Cosmos on Noble. Again, we could talk a little bit about how Noble solves for these pain points that Circle had, but I just want to give that background kind of context because a lot of people have asked like us, especially as we've been raising funding for the venture, why is Noble necessary, right? Like why does it even need to exist? And really you kind of have to take a step back at that point and understand Cosmos kind of as a whole. So I'll stop there.
Well, we'll get into all that. Like understand what the role of Noble is. I think just by way of background for the listeners, UST I think is this asset that people remember the collapse of. And just to be clear, like the fact that it was built using Cosmos tech doesn't mean that it was like a project of the Cosmos team per se, right? It just means that they used this open protocol and this toolkit to do it. And I remember UST was the number one a trading pair, right, with almost any asset on the leading decentralized exchange, Osmosis. We've had Sunny on the show to talk about that. And when UST collapsed, basically, there was no real easy way to exchange any Cosmos asset with some US dollar equivalent. Now, UST and USDC are totally different from each other. UST was an algorithmic stablecoin that was not fully backed, whereas USDC is a much more traditional financial asset, right? Where the company Circle has collateral held in a U.S. regulated financial institution in government bonds, short-term government bonds, right? And because it doesn't pay any interest, there's no duration risk or anything you might see with a bank. It's like super duper simple. And it's a great business model that they have. And their goal, I've talked to them before, Jeremy, at length, actually, relatively recently. And, they view themselves as this asset that they want to deploy it across as many different environments. And so they've integrated with centralized exchanges, decentralized exchanges, different blockchain platforms, traditional companies, MasterCard, Visa. And so to me, it's like very positive, obviously, for Cosmos that they're finally getting around to launching on Cosmos. Now, I think based on what I know about Cosmos versus some of those other platforms, Cosmos is the most decentralized and perhaps disorganized of all of the platforms that are out there. And so, like when USDC says we want to do XYZ, there's going to be like the whole marketing team from Arbitrum will come and knock in, or from Avalanche. And there's going to be a whole like group of people, and they're all going to be representing this thing, kind of like a company. And Cosmos I view much more as this open ecosystem, and I think that's its greatest strength, and sometimes a source of frustration. But we don't have to get into that. But so it seems like Cosmos needed you to someone to step up and explain this idea of app chains and to actually deploy the coin on the network. So tell us about that discussion. Like, how hard is it, or how easy was it to explain to like a company like Circle how Cosmos is different? And once they figured it out, was it like aha moment? Like, I wonder if we could just talk about that experience, but is that scalable for other kinds of more traditional businesses looking to do stuff in this environment?
Yeah, I mean, it's a great question. I kind of started the story like about a year ago when Terra collapsed and everything went to, kind of went to zero, and a lot of DEXs and kind of DeFi protocols that were dependent on UST were also seriously kind of harmed in the process. But there's actually an even longer story, which goes back, I guess, a year prior to that. So about 2 years ago, 2.5 years ago, when IBC actually launched. So IBC was IBC was and is this like very kind of useful protocol within the Cosmos ecosystem, which allows two independent chains to set up a connection, an IBC connection, where they can permissionlessly pass data, pass messages between those blockchains. And the main application is with token transfers. And so when IBC launched about 2 years ago, and we actually had token transfers enabled, I think the first token transfer was between the Cosmos Hub and Osmosis, if I'm not mistaken, Jack. We actually, around that time, reached out to the Circle team and sort of tried to kind of explain and do a little bit of education around IBC, why it is this incredibly secure, permissionless, flexible, modular sort of way of doing message passing between blockchains that we, saw would have a lot of volume, activity, users, useful applications, etc. That was a great exercise, and I think one of the calls, even Jeremy might have been on it, if I'm not mistaken. However, at the same time, there was that missing layer of, you have IBC, you have a way to permissionlessly communicate, but you still don't have kind of the infrastructure or sort of the secure kind of mechanism to actually deploy the asset, right? In the way that you would on Arbitrum or Ethereum or on Solana, et cetera, right? There is no one canonical sort of smart contracting layer. There is no one logical place to mint, burn, blacklist the asset. There's no one sort of logical place to have kind of hook into the Circle APIs, et cetera. So it was a great exercise, and IBC, to this day is kind of evolving from a narrative perspective and also from a utility perspective. I mentioned token transfers are the main application, but there's also like other things you can do on top of IBC. And so, it was great, but I almost think we were a bit too early about 2 years ago when we tried to get Circle to issue USDC and Cosmos. And so really out of like necessity, a year later, 1 year ago, you had a very different kind of situation and a very different conversation. So, from my perspective, it did take quite a lot of time, especially like for our industry, I think, to still do that education and to still come up with like a framework and like a design that made Circle comfortable for how they would issue USDC. Before the chain was called Noble, it was just a generic asset issuance chain. Like that was sort of the going kind of terminology that we would advocate for. And it just took a lot of time, I think, to kind of get everyone comfortable. But I don't know if Jack has something to add there and how that whole process went.
Yeah, that's a good one. This Bitcoin started this narrative where there's going to be one blockchain, there's going to be one asset, and everything is going to kind of filter down to that. And Ethereum picked that narrative up back in like 2015, right when they started. And if you look at the ETH roadmap, it is very ETH centric in terms of like ETH the asset, ETH the chain, ETH the concept. And Cosmos is a lot more like Unix philosophy for blockchains. Break everything down into modular pieces, enable those pieces to be kind of endlessly reused and mixed and matched, and use those modular pieces to break through scaling bottlenecks. And that leads to a much different architecture than people are familiar with in Bitcoin and Ethereum. And I think a lot of the work, as Jelena is pointing out well, was talking circle through the different pieces of the architecture and helping them understand it. And there was a lot of education work to be done there.
Yeah, and I think so. We're like big fans of sort of the modular app chain approach on this show. But one of the issues with app chains is you have to sort of bootstrap all the different pieces that like a generic L1 like Ethereum would have. And so one thing that's always been sort of on my mind is how the biggest risk factor right now to the biggest source of hacks and things like that is obviously bridges. And so one thing I'm really interested to know is because obviously the issue with app chains is it's tough to, as a new app chain, it's tough to get USDC Circle to issue USDC natively on your chain. And so is that something that Noble sort of helps? So like by using Noble, any Cosmos app chain automatically has access to natively issued USDC. Is that correct?
Yeah, and I just like Vitalik dropped another post on bridges today that I haven't fully read, so I might be misrepresenting it. But I think that if we get back to this like Unix philosophy for blockchains, one of the key pieces of that is you need processes or different pieces of your architecture to be able to communicate seamlessly. And this is what we've built with IBC. I think a lot of the rest of the blockchain ecosystem has been messing around with a bunch of different bridges. Many of them have been hacked, and a lot of them are based on centralized intermediaries. IBC is the only in production at scale bridge that's based on the cryptography of the underlying blockchains. It kind of makes intuitive sense. If we have these verifying systems that any actors can verify, why can't you use two of these systems to verify each other and have a shared communication channel? And what we've had differently in Cosmos is we don't have hacks. We don't have the same level of security issues because we've formally verified this protocol. We've worked really hard on the security pieces, and we've worked really hard to make it seamless for users. So back to your question, why doesn't Circle just issue this all over the place? That's a lot of upkeep for them. Every USDC installation they have has a lot of internal monitoring and various things that they build. And I think initially they had this approach where they were like, we're going to get USDC to pay for itself because this is a zero interest rate environment. We're going to get USDC to pay for itself by getting the people to pay for issuance. And that was their approach for many years. Mm-hmm. And what they found is there's costs to that. You get one upfront whack when somebody gives you $5 million to go issue USDC on, say, Avalanche. But then you have sort of infinite costs after that, and you always have to maintain that installation. Otherwise, you're basically debanking your users there. That sucks. So what they've done is they're now sort of pivoting, and also because the interest rate environment has changed, they're able to make a lot more money on the float, and USDC is suddenly massively more profitable than it ever was in the zero interest rate environment. They pivoted to thinking more strategically about the new outposts that they're building for USDC and how those outposts can serve more and more users along with bridges. And this is what Noble brings, is that native IBC integration and the ability for Noble as a chain to build features that enable much better user experiences via IBC because we're this liquidity layer. And in that way, USDC kind of becomes native to all the different IBC chains that are able to connect to Noble.
So that's really interesting segue for me into what's the business model for Noble, because we now know that how Circle makes money today. And just so it's clear for everyone who's listening, when your collateral is bonds that pay you no interest, then you're not making a lot of money. But in this environment, like the bonds they own are risk-free assets, meaning simply issued by the US government. And they're yielding like 4 or 5%. So like if they're depositors users are expect no interest, and they are collecting all that interest, and then they make this massive net interest margin between those two things. And so now I can see why they would probably even want to invest in deploying on Cosmos, because it's like you got to lay down money to pick it up, right? Like if they can get some success by launching, and then this becomes the UST equivalent, and they're churning billions of dollars like UST was back in the day, and then beyond that, like who knows where it could go, then it obviously makes a ton of sense. So that's why they want to do it. What's your model here? Jelena, do you want to take that one?
Definitely. So we actually are looking, this obviously isn't live yet, so these are still hypotheses, but we're anticipating to make sort of on-chain revenue in the similar way that other blockchains make revenue, which is through on-chain transaction fees. So in the immediate term, we're actually looking to make transaction fees of USDC via Noble like close to zero. The reason being is we're looking to incentivize like a whole bunch of liquidity kind of coming into the Cosmos ecosystem. Nice thing about Cosmos is you can actually have $0 transaction fees, because the kind of native gas fees are so low, like already close to zero. So the kind of additional fee mechanism, which is simply an IBC kind of token transfer fee, we're actually going to be making zero. And so that obviously will not generate a lot of revenue, both for Noble, but also our validators, which will be securing the Noble chain. But in the future, we anticipate to sort of ramp that up to a number that is very competitive, actually not just kind of within Cosmos, but actually within the entire crypto ecosystem. So right now, obviously on Ethereum, gas fees are, very hard to manage, very hard to control, fine tune. Even on layer twos, they've obviously kind of cracked some scalability kind of challenges, but at the same time, you still do get unpredictable gas costs that make even like layer two transaction fees also somewhat, tricky to manage. Mm-hmm. And then, beyond sort of that environment, we're anticipate to be very competitive just with bridges in general. So right now, for example, like the kind of metric that is well known to bridge in USDC into Cosmos from Ethereum via a bridge like Axelar, there's a flat fee that actually subsidizes the gas cost on the ETH side, which can be anywhere from like $5 to $10 per transaction, regardless of the size. So, I mean, these are obviously like very like tricky kind of user experience challenges to manage, like not just for like the chain kind of doing the issuance, like such as a bridge, but also obviously like for the front end user, which, depending on the day, the fee can obviously kind of modulate. So for Noble, that will be a lot more predictable. It'll be very transparent. Obviously, it's all on chain. And that's really kind of the mechanism right now. We are still playing around with like different like fee like amounts and kind of models, whether it's simply like a flat fee per transaction or something more than that is like to be determined. Yeah. But we are pretty excited about sort of how easily you'll be able to kind of modulate fees on Noble versus something like even like a Polygon, for example.
Yeah, that makes sense. I think like one thing I'm really interested to know too is as kind of like almost like an asset issuance chain. We've talked a lot on the show about sort of RWAs, like real world assets, and tokenization of traditional financial assets. And up until now, it's been pretty much strictly stablecoins that have come on chain. But over the last I guess couple of months, we saw the first sort of on-chain treasuries come online, and I'm curious, what do you think is kind of the next big growth area of on-chain real-world assets? Do you think it is treasuries or maybe financial assets like stocks? Or I'm just kind of curious from your vantage point, and then sort of a secondary question. We've seen some sort of false starts in the past over the last 5 years of different sort of real world assets. Do you think now like the infrastructure is finally in place for sort of a significant takeoff in on-chain tokenization of assets beyond just kind of stablecoins?
Sure. Jelena's got a lot of thoughts on this, but just real quick, it's been, you guys have been in the industry forever. You've heard this so many times. The institutions are coming to save our bags. And like, this has been the thing that people just say over and over again. And I think that I always look back to the beginning of Cosmos back in the 2015 to 2017 era when Bucky and Jay were trying to sell Tendermint to banks and like other large tech companies, because it is fundamentally a great clustered database. And back then it was too soon. And famously, we had 2017, which was this sort of coming out party for public blockchains in a lot of ways. And, we've lived in that world since then. I think that, we saw a lot of institutions come in the last cycle, and most of them have stuck around. Fidelity still offers this stuff. And now I think that I'm going to say this, and this may not age well, but I think that the regulatory environment, we've kind of reached max fear right now. There's been this Operation Choke Point 2.0. My company got debanked. we banked with Signature and Silvergate, and we thought, great, 2 banks, we're great. And we didn't have a bank, so we've had to switch. And, I think that if we fast forward a year, what's likely going to happen is a lot of these court cases are going to go the way of our industry because the regulatory overreach has been extreme. Gary Gensler and Jelena in the US, they've been really aggressive. And I think that the courts and Congress are going to rein them in. And I think that the BlackRock ETF application this week and a few other things are kind of pointing in that direction. And Alex, you opened the show today talking about institutional adoption.
Like you can't not. I mean, just not to interrupt, but
it's just it's happening. And that I think that the large institutions see that we've reached that point of max fear from a regulatory perspective.
I think it's max fear, but it's also like max uncertainty, right? Where it's basically what exactly is the market pricing in? It's pricing in a scenario where everything that the SEC is alleging is where we'll end up. And the world is a complicated place, and there are lots of different stakeholders with varying agendas. And a lot of people, and we talked about this a couple of episodes ago, there are several lawmakers on both sides of the aisle who view this as basically just a part of the bureaucratic state kind of overstepping its range a little, and it needs to be sort of hemmed in slightly, and that's going to lead to a different process. And there's not a judgment call on any one of these groups, but simply to say that things don't just kind of run in one direction without getting pulled back at some point.
Yeah.
So I think that there's probably going to be some resolution. And by the way, obviously, our view, my view, I should say, I don't want to speak for Andrew, is that using a test that was applied to a grove of oranges in 1946 to judge the merits of a decentralized network with a native token is kind of limiting to a degree. And I actually joke about it. It's if anybody wants further proof that many of these things are sufficiently decentralized, just look at Cosmos. It's if Cosmos were a company, things would get done more quickly, and the people would fight less with each other.
It's very much so. My life would be way easier.
This is the farthest thing from a company that I've ever seen in my entire life. So anyway, so I like to poke fun at you guys.
That's what I love you.
But it's you must be joking. If anybody looked at this, they'd be like, yeah, there's no company here. Sorry, this is not a securities offering. This is nothing like that at all. And I think that'll become clear as people who are thoughtful. There are lots of thoughtful people in government, and there are lots of people who care about innovation and who want to see this industry have a chance of really succeeding, and who are going to look at those facts and make judgments for themselves. And I think that those judgments and conclusions might be very different from what a couple of individuals in the regulatory apparatus think of this place.
Just to bring it back to your question, Andrew, of where do you think we're going to see real world asset adoption? I think that regulatory precedent is extremely important. And I think that the announcements over the last couple of weeks in terms of legacy financial institutions coming in kind of points the way forward there. The intended recipients for these capital market assets have always been large institutions, and they've been reluctant to enter these markets for a variety of reasons. If we see a situation where they start to rush in, all of the asset classes you mentioned are likely to see explosive growth. while we're transitioning over to this new tech stack and this new financial markets paradigm, that, you know, Alex, you've got the logo in the background, blockchain revolution. Like, this is sort of, I think, going to be seen historically as kind of a pivotal moment in that. So on-chain treasuries, in Cosmos, we've long felt the pain of only holding treasuries in a volatile asset. And I think that, you know, products like Zampolin are starting to see some traction with some on-chain treasuries, and like a lot of these like more active management products that have kind of been moribund over the last couple of years, last like year, really. I mean, Yearn Finance reached its peak in DeFi summer and has kind of been going down since then. So I think that we're likely to see significant growth in all of those asset classes. On-chain treasuries is one I'm personally really interested in. Jelena, I'm sorry I was a little long-winded on that, but I know you've also got thoughts here.
No, it's good. I mean, we are obviously very biased, Jack and I, but I genuinely, truly believe that Cosmos is the perfect sort of ecosystem, tech stack, even philosophy to issue RWAs or real world assets. You know, even on Noble, there's a very straightforward way to kind of separate concerns from an issuer's perspective. So, you know, if you're looking for even a permissionless path to issuance, right, where you can sort of propagate the asset relatively permissionlessly to all IBC connected chains, you could do that. You know, if you're an issuer that has certain kind of requirements for kind of compliance, regulatory, blacklisting, whitelisting, things like this, it's very straightforward to do that. You know, the Cosmos SDK is built in a way where you have all of these sort of, you know, independent kind of modules and components that can all live simultaneously running on the same infrastructure layer, right, on something like the Noble blockchain. But from like a user's perspective, and even from like an issuer perspective, you know, you can sort of separate those concerns very easily, right? So you're not going to have something in Cosmos like you have in Ethereum, where all of a sudden, you know, Tornado Cash is being sanctioned, and you have Ethereum validators actually not validating blocks that contain Tornado Cash because it could be a violation of OFAC. You don't have that kind of concern to that degree, because you can very much partition kind of concerns based on, again, like the asset, the issuer, which paths it flows on, right? Like there's, in the future, we do anticipate different like IBC sort of standards. Right now, the IBC kind of standard that is most common is the ICS 20 token transfer standard. ICS stands for interchain standards. Right now, that's relatively, you know, kind of open. You know, it's not natively blacklistable, but in the future, it's very likely that there could be a token transfer standard that is natively blacklistable, again, to kind of conform to the issuer's kind of needs. So in this sense, it's, you know, a lot, I guess, like the internet, where you have these sort of independent kind of ISPs that all sort of like, you know, enable kind of permissionless communication between, you know, independent computers. But at the same time, like I can't necessarily access a website that for whatever reason the Canadian government has deemed to be dangerous or illegal or whatever it might be, right? And so it's a very similar situation, I think, in Cosmos, where you can kind of separate those concerns on chain, which to me is very exciting. Obviously, right now we're starting with one asset, USDC, which can be considered, like, in my opinion, definitely a real world asset, like by definition. But in the future, like, I guess to Jack's point, you know, you could definitely do T-bills. I feel like they're very hot right now just because the interest kind of on those bills are pretty attractive.
So hot right now, T-bills.
It's just, yeah. So it's kind of hard
where have we come? Yeah.
Always have been.
Yeah, exactly.
So, you know, we'll see where it goes. But regardless of what that asset is, Cosmos is the place to issue it.
Yeah.
That's the pitch.
Yeah. Oh, I love that answer. Andrew, do you want to hop in here?
Yeah, no, I think that makes sense. It's talking about the T-bills, actually, it's been kind of interesting because I mean, this is not to go too much into the whole yield space, but it is interesting how stablecoins have been kind of growing pretty consistently, even though in a lot of ways the opportunity cost of holding stablecoins has never been higher, in the sense that you can, having money in sort of traditional fiat-based systems, you can generate, you know, 5-6% yields. So in a lot of ways, we almost, if we stay in this like higher rate environment for longer, we almost have to bring on treasuries on chain, because there'll just be a crowding out effect where people, you know, it's better to just keep your money in the traditional fiat system. And I think it'll hurt a lot of sort of DeFi lending platforms as well. But like obviously our show is called DeFi Decoded. So I would be remiss not to ask sort of your thoughts on what do you guys think of sort of the DeFi space over the next 6 to 12 months? Are there any sort of trends you're seeing from your vantage point that me or Alex aren't seeing, or particularly our viewers? There's been sort of a push. We talked a lot, for example, on the show about Cosmos DeFi and how we think a lot of DeFi protocols will eventually launch their own application chains. We saw recently last week, Frax, for example, is launching their own Frax chain. So yeah, I'm kind of curious what if there's some things in the DeFi space that are particularly exciting to you.
Jelena, you want to start on that one, or I've got.
Yeah, I'll start. Yeah. So I mean, I'll kind of take it back to the Cosmos context. So one, like the main kind of challenge right now within Cosmos to more sort of like mass kind of adoption of DeFi and just like generally like more TVL and like just generally like applications like actually succeeding is a lack of liquidity. So there's like a few things that are happening within Cosmos that I will, we anticipate kind of move kind of that trend towards a more positive direction. So one definitely is Noble, right? Like having like native USDC, having the institutions alongside of that like asset kind of come in and be comfortable with Cosmos, everything from custody to to actual sort of the fact that you can mint directly if you're a market maker, or you are an exchange, even you can mint USDC directly like in Cosmos, like all of a sudden just like increases sort of the usability, or I guess increases the attractiveness of being in the Cosmos ecosystem in general, not just holding USDC, but maybe taking that to osmosis, like LPing, market making, like whatever it might be, right? So the fact that we will be having native USDC, I think, will change that trend somewhat. And then another thing is also liquid staking. So this is something that Cosmos I think has always been ahead of the trend on. I don't know if Jack would agree with me on that, but like the fact that we've had a lot of like open discussions and like research papers around like liquid staking and Cosmos. The fact that you can like all of a sudden my staked atom like on the Cosmos hub is actually like usable, right? No longer locked up, and I can take that liquid staked atom and to some sort of like LP pool, or I can trade it for like another asset. Like all of a sudden that's like very attractive as well, I think, from like a liquidity generation perspective and just a usability perspective. A lot of people I think historically have been like frustrated, right? Like three-week unbonding, like all of these things. Well, it's no longer kind of necessarily a pain point. So we have really great projects like Stride and Neutron. That's actually the same team behind Lido, building a liquid staking product in Cosmos. So all of these things kind of point to the same outcome, which is just like generally more liquidity, usability, ability to kind of go between app chains as well, in a kind of in a straightforward way. So yeah, I mean, I would say those are the two factors that will hopefully lead to more DeFi adoption in general. What those DeFi products are, I think, is like a separate discussion, but I think it's ultimately quite positive. I don't know, Jack, if you have any thoughts on that.
Yeah, I tend to agree. I think that another shift, and this is kind of a slightly controversial opinion, that we're likely to see is as these DeFi chains move to other chains, most of the DeFi infrastructure has been built assuming a synchronous environment. And there's a lot of discussion around like flash loans and sort of how do those work in an asynchronous environment. There's going to be a huge shift and rebuild of a lot of these fundamental protocols and sort of how they work for the multi-chain ecosystem. Look at MakerDAO's in-game thing that they've got going. These infrastructures are going to rely much more on bridges like IBC and that transport layer than the Ethereum community as a whole has been thinking for years. And I think Vitalik's blog post today is like a great example of that. Like he's talking a lot about this inter L2 communication. Like they're just blockchains and they need to talk to each other. And I think that, the entire industry has kind of come our way after years of telling us we're wrong. And I think that this is the next thing that we're going to be right about and sort of ahead of everyone else on is I think that the way that this conversation has come up is around this conversation around intents, where end users will specify, I'd like this to happen with these constraints. Like, I want to go trade this asset for X number of this, at least X number of this other asset. And they send the transaction out. And what ends up happening is not a bunch of machinery on one chain. Messages get sent out to a couple of other chains. Potentially parts of the trade get settled, and then all comes back to the end user. And in an architecture like that, it is much more complicated from a developer perspective in a lot of ways, but it's much more scalable. And it's the architecture that we're moving to with all of these DeFi apps building app chains. So I think that that's going to be another shift in the infrastructure space over the next couple of years.
One thing I always wonder about is, are these models of token incentives really sustainable for a lot of these projects? Like, a lot of these early DeFi projects incentivized users by providing, token rewards for being liquidity providers or whatever. And I just wonder, like, that works for a time, but then someone else comes along and it offers a better reward. And, it's unfortunate in a way because, when internet users become internet owners and they're like, they have a vested interest in the success and the token goes down, then they lose interest in the service as well as the financial reward. And I'm always like, I don't want to single anyone out, but there's a decentralized exchange in the Cosmos world that, like, I think is seeing it's struggling a little bit because of this issue. And you guys probably know what I'm talking about. I'm just wondering, like, where do we land on that? Andrew has got a really good view on this about, sustainable token models and how to, drive value to token holders and so forth. But just wondering if you have a perspective on that.
Yeah, I've got a lot of thoughts here. Jelena, do you want to go first, or do you mind if I?
You go for it, because my
Cool.
main thought is Noble doesn't need a token, and
Okay,
I want to
yeah. Look
at
at the projects I've been most closely associated with over the last couple of years. The first one, Sommelier, we have a fixed supply token that drives revenue to Som holders.
Yeah.
It sells products and drives revenue directly there. That is the way a company works. You bring in money and that gets paid to the people who own the thing. This makes sense. And then Noble, which is kind of a proof of authority chain that's looking to raise shared security. I think that one of the other big shifts that we've talking about, and like I've kind of alluded to it with modular, is that roll-up architectures are going to be a huge part of the next wave. And the communication between those roll-up architectures and the L1s of yesteryear is going to become increasingly important. You can easily launch a roll-up without a token. So I think that a lot of Cosmos chains launched tokens to secure their L1s, and that's great. But we're entering a world in which you don't need to do that in order to build your own app chain, and you can still have all of the benefits of doing it. So I think that it's going to be in a much better model. It's going to be a lot better of an opportunity for apps to build strong token models rather than kind of being forced into launching a token, which is what the case has been for a while.
Cool. Then one other question I had, which is to Andrew's point about yield. Can I get a USDC with a 5% yield? And can I buy that as a coin that gets paid like as a airdrop into my like Ethereum wallet or my Kepler wallet or something? Like, can we just, does that exist, AY? Where it's like,
well, I think that's the
it's not like hocus pocus yield, it's just yield from the bond. Does that exist?
Yeah.
It exists
Yeah,
with Coinbase. Yeah, Coinbase has a rewards program for doing that exact thing. But I think an on-chain mechanism for that same thing could be pretty interesting. Although, yeah,
just be nice to have it like just go to a like in the same way that like a staking yield or whatever from like staking an asset gets paid to like your wallet address. It would just be nice if you could do that, but it was like in kind. So it's not like, to your point about, I think it was maybe Jelena about on-chain treasuries and them being super volatile. Like, just imagine your on-chain treasury was in like if you're a company, not to go down a whole rabbit hole here, but when you have cash and cash equivalents, like most of those cash equivalents are like short and medium term bonds because they pay you some yield, right? Like versus like pure cash. And so like would make sense that, if you were an on-chain entity or whatever, some Web3 corporation, and you had a on-chain treasury, that some of it would be earning some real yield in some way, right? I don't know. It just seems like a kind of like low-hanging fruit. Is that the kind of thing like Google's going to do, or should I do it? Like with Andrew? Like what?
Alex, yeah.
Go ahead.
What?
Oh, no, I was just, I was just saying, like, you can, like, just to answer your previous question, it looks like there's an open Eden T-bill vault where you can buy, this is sort of what I was talking about earlier about seeing on-chain treasuries finally come online. You have to do like full KYC, and it looks like it's it's essentially like a Cayman entity that it's essentially a Cayman SPV that holds treasuries and then passes it back to token holders. And it's past $10 million in TVL. So it's very, very, very new, but it looks like on-chain sort of treasury products are finally here, which is pretty cool to see.
Arrakis Finance is also doing this too.
Yeah.
Arrakis?
Yes, as in the Dune planet. Yeah. It's a great name.
Is it called a yield spice?
Yes.
If not, it should just like sprinkle a little.
The one thing I'll say though is earning yield on your stablecoins is something that the SEC doesn't like.
Yeah, I would think so.
Yeah, Paradigm actually, well, not that they don't like it necessarily, but it's like a better argument, I guess, for them to deem them securities. Paradigm did like they filed a pretty legitimate kind of amicus brief ahead of some congressional hearings on stablecoins and, just generally securities treatment of cryptocurrencies. And they kind of identified and I'm not a lawyer, but they refuted, I think quite well, the kind of notion that just because you're earning yield on a US dollar kind of backed stable coin does not necessarily make that stable coin a security. So if I gamble with my US dollars and I like make a profit, like I don't know, there's like different ways we make profit with kind of stable assets, and like just because you're able to make a profit or generate some sort of like return, I mean my TFSA generates a return, and I mean, for the Americans, like TFSA is an interest-bearing savings account that banks offer, right? Like that doesn't make the Canadian dollar a security, right? So anyways, there's like all of these like logical kind of mental leaps, I think, that are kind of being made to kind of refer to stables as kind of securities. But anyways, the SEC doesn't like when you earn yield on your stable coin. And I will say, the Anchor protocol and the fact that at one point in time you can earn 20% of yield on your USD probably had something to do with that.
Yeah.
But anyways, I digress.
Well, I've asked Jake, my associate, to chart the 1-year T-bill against the growth in stablecoin market cap, to Andrew's point, which is like the yields have gone up and at the same time stablecoin values have gone up, which seems counterintuitive because it's effectively a zero yield, instrument. But I think it points to like a different kind of story, which is that access to US dollar payment rails is still not available to everybody. And in DeFi and in crypto specifically, it's a really useful tool. And so there's going to be product market fit that is totally separate from it's not, people aren't trading off money market fund versus a stable coin. They're trading off, do I have access to a digital payment tool in US dollars, do I not have that tool? And so having that tool is obviously going to lead to growth. But I have to think that like figuring out the yield question would absolutely turbocharge that growth. And it seems like a big opportunity. Perhaps something for a later date. It seems like right now, Jelena, you've got more than enough on your plate. Congrats on securing Circle, being the official, partner. And I think that, we already have a proof point that there's enormous demand for a good US dollar instrument in Cosmos. And that's from a year and a half ago. And I think where we're headed, there's going to be far more utility because we're going to see, as Andrew pointed out, real world assets and other kinds of functionality. So seems like you're in a really good spot with a unique position, and we wish you the best of luck. And it's been great to have you on the show. And Jack, we appreciate you joining as well, and everything you're doing to help in building this thing out. And we hope to have you both on very soon to give us an update.
Alex, anytime. Let me know.
Maybe for the 200th episode.
The 200th episode. Oh my Lord.
Hopefully sooner than that.
Yeah.
Well, I mean, they're already 101, right?
I know. It's like every week. Sometimes we do 2 a week. It's actually nuts. I don't know why.
That's awesome.
But yeah, it's fun. It's fun for me. I learned so much, I try not to be afraid to ask questions that might make me seem dumb, because like if you don't open yourself up, you're never going to learn. And so I feel like I've learned a lot on this one, as I do on every other one. And I really appreciate all the great insights. That was a lot of fun.
Thanks, Alex. Thanks, Andrew.
Awesome.
Yeah.
Thank you, Alex. Thank you.
Alrighty. Thanks, guys. Well, that's it for this week's. Yeah, that's it for this week's DeFi Decoded. Until next week, have a good one, and we will see everybody later. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.